Two things that every investor should know about to be a smart taxpayer are that not all income is taxed the same, so you generally want to hold bonds in a retirement account and stocks in a taxable account. To understand this, let's consider Sharon and Mark's retirement account. We always start with a long-term plan, which includes choosing risk and asset allocation before worrying about taxes. They have decided that the correct risk level for their retirement portfolio is 60% stocks and 40% bonds, increasing the allocation to bonds by 1% every year. Their preference is to own the total market stock index funds with 2/3 from U.S. companies and 1/3 from international companies. For bonds, they choose the total U.S. bond market index fund. They've got taxable, tax-free, and tax-deferred accounts. Tax-advantaged accounts are the most efficient place to invest, so you want to take maximum advantage of these. Sharon's been contributing to a Roth IRA with some of their after-tax earnings every year. All of the growth in this account will be forever tax-free. Mark has a 401k retirement program with his employer. This, like traditional IRA accounts, is all tax-deferred. They pay no taxes on income he invests here or on any growth of these investments until he uses it during retirement, when it all gets taxed as ordinary income. Best of all, his company matches some of his contributions. Let's consider their tax situation. As they earn more, the last dollars they earn get taxed at higher levels. Say they are in the 25% marginal tax bracket. While they pay less than 10% of their total gross income on federal income taxes, the important thing is that of the last dollar they earned in wages, 25% went to these taxes. Now to the first point of this video. Let's consider how their investment gets taxed. It turns out that the interest and dividends you earn from your bonds, bank CDs, and savings account are all taxed like ordinary income. Now with stocks, you own a portion of these companies and they distribute some of their profits to you as dividends. Secondly, as the company grows, the value of these shares appreciate, so you hope to sell it for a higher price in the future. If you hold the stock for a long time and the price goes up, not only do you get to defer paying taxes on the appreciation until you sell it, but this is long-term capital gains tax at a lower rate. There's more good news. Currently, the earnings that are distributed each year as qualified dividends are also taxed at this lower rate. Now, some mutual funds that are actively managed do lots of buying and selling, trying to beat the market. This turnover creates extra capital gains that we have to declare and pay taxes on now instead of deferring these into the future like we would prefer. The best mutual funds are going to have low turnover in addition to being low cost and widely diversified. The best choices are usually index funds, but they aren't always. It's these attributes that are important. Getting back to our example, after they've considered risk and asset allocation, Mark and Sharon determine the tax efficiency of each of their investment assets. We want to place bonds in their tax-deferred retirement accounts, or more precisely, those investments that have the highest tax cost. This is the main point, so if you only remember one thing, remember this. Other recommendations. Generally keep your foreign stocks in your taxable account, where you can get a foreign tax credit. And usually put the fund with the highest expected return into a tax-free Roth IRA. Fill up the remaining space in your tax-advantaged account with tax-efficient stock funds, and then hold the rest in a taxable account. For this example, here's how it ends up looking. There are many other benefits to having stock funds in a taxable account, so I'll provide you links to these topics if you want to explore them. One topic that will impact all of you is record keeping for your taxable account, since you usually want to keep track of the cost of every share you buy so that when you sell it, you can sell the highest cost shares first. I've got a link to tips for this as well in the transcript to this video. Find other explanatory videos, smart tips, and links to useful resources at financinglife.org.